Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Carol Schleif is Chief Market Strategist, BMO Private Wealth, and I can't say enough about the elegance of her notes. She's got decades of experience just thinking through where we are. You have a lovely phrase, Carol, that just captures the moment. Investors remain anxious. Do we have to be anxious to go higher?
Well, I think definitely that wall of worry is typically what we've seen through this whole bull market that we've been in, whether you peg it the shorter term one from April on up or the longer term one that really you can date it back to almost the pandemic on up, or especially after the 2022 pullback in there more rightfully. But still that grinding higher where investors are always have this long list of things they worry about. And when you get markets like we have the last few days, they take all of those things, dump them out on the floor and obsess about all of them in the short run.
You're lucky you get to live with Ian Lingen, who's really, really better than good at the Bank of Montreal. And I looked this morning at the inflation-adjusted interest rate trend, real interest rates, bank credit analyst, again, out of Montreal. What is it about Montreal?
I don't know. They're pretty good.
Maybe BMO can solve the Canadians' problems. Carol, I look at the real interest rate, and bank credit analyst says this is a critical driver, and they're optimistic because they see real rates coming in. Do you agree?
Well, I'm not sure if real rates come in or not. There's a lot of things to sort through, and granted, we'll get a lot. We're already starting to see some of the trickle of those government statistics mill that'll help us see that. And I think the big linchpin here is everyone's trying to figure out, will tariff impacts come through? What does that do? Is it inflationary? Is it deflationary? We're having all sorts of conversations around that, but it really is important to see where that levels out. But I think the important thing also is to realize that we need to resist the urge to anchor to the last 10 or 20 years where those real rates were and anchor instead to that pre-zero or zero interest rate, negative interest rate environment that we were in that we all got so used to.
Carol, we're going to hear from Nvidia, their results after the close tonight. Once again, bringing into focus kind of this AI trade and its impact on the overall market here. Carol, are you concerned, as some people are, that there's an AI bubble that may be kind of inflating this market or overinflating this market?
I think there's a concentration definitely in the indices and in representation and probably in some of the contributions to GDP. But we think you're in the really early innings. And it's also really important to understand that the vast majority of this has been funded out of cash flow for big legitimate companies. And when you actually think back, the names that we're still talking about that are able to grow revenues and earnings double digits and with double-digit margins, some of those names were the ones that were around during the 95 to 2000 run-up, which is pretty unheard of in this industry. And so we think you're early on yet. There's a long list of things we're watching, as everyone else is, in terms of somehow the financing and that. But overall, the leverage, the valuations are lower than the street perception is because of how the earnings have come along.
Carol, one final question. I'm confused. Where are we on cash? Like Bank of America had some note out saying institutional investors are low cash, they're fully engaged in the market. Sweeney tells me here there's trillions of dollars of cash on the sidelines. Where are we on cash? Is there a lot of cash out there?
I think there's cash, there's liquidity, and there's also, it's not necessarily an overt amount of cash, but this is the time of year people start bringing bonuses in and things like that for our individual investors, which is where the bulk of my focus is. But there's been cash that got sidelined. Every time you've had a pullback, you've had some people that have rearranged and asset allocated out of it, looking for an opportunity to get back in, which is where you've got some support underneath it all.
Thank you. Are we less anxious after talking to Carol?
I think so.
I think so. Carol Schleif, thank you so much. With BMO Private Wealth, the Bank of Montreal Private Wealth. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
The way we roll here is we do audibles when they are appropriate. And with Dr. Thin darkens the door, Win Thin, Chief Economist, Bank of Nassau, just iconic on the street with his academics out of Columbia. And we have the Prime Minister of Singapore, the Republic of Singapore, with us earlier. You got to do an audible. Win Thin is from what will always for me be Burma. It's 1,300 miles directly north of Singapore, up through Malaysia, up the west coast of Thailand, Win Thin to your Myanmar as well. How alone does Singapore feel in Southeast Asia? I mean, do they feel discrete and separate, or is there a true alliance?
I believe they are really part of that ASEAN alliance.
He talked a lot about that.
Yes, absolutely. And, as the U.S. steps back, these sort of regional agreements and organizations really become more important. And so I think, if anything, this is, I think the U.S. by pulling back is sort of strengthening these institutional frameworks that are already in place.
One question then, we have projected 4 military bases in the Philippines. When we project military bases to the Philippines, I think John Micklethwaite's first question was on Taiwan to Prime Minister Wong. Are we projecting 4 military bases to Singapore as well when we plant them in the Philippines?
I would say that Singapore, I think, prides itself on being somewhat neutral.
Yeah.
It's caught between the U.S. and China.
I love this. Is it the Switzerland of Southeast Asia?
No, that's a great analogy. As Hong Kong is sort of fallen more and more under the mainland oversight, I think Singapore has an opportunity to really stand out as sort of this a bastion of free capitalism, free speech, etc.
Thank you. Was that a good audible?
Good. Very good.
We'll do it again sometime soon.
All right.
Paul, would you save the interview?
Yes. You economists have to go back to work tomorrow. I mean, we're going to get a lot of data coming out tomorrow. How are you going to approach it in terms of prioritizing what's the most important, the quality of the data? How are you going to think about it?
Absolutely. Well, the theme of most reports are going to be jobs, jobs, and jobs. Okay. So the Fed could potentially, and I think likely will have 3 jobs reports in hand before the December 9th, 10th FOMC. Wow. We've got the September, and you look at my calendar here, we have the September tomorrow, and I think the November will come out on time on December 5th, and I'm just assuming that the October one will come sometime in between if all goes well. So what am I looking for? Well, look, if you look at all the ancillary signs, the alternative data, there are cracks in the labor market. We may get 1 or 2 outliers, but I think the trend is there. ADP, NFP don't always line up, but ADP does get the trend, and the trend is really one of weakness. So that's why I've been kind of beating this drum for a while. I think one of the things that markets have been happy about this last few weeks is like no news is good news. Mm-hmm. And people are clamoring for data, but it's kind of like be careful what you ask for, because I think we're going to get some weak data coming down the pipeline. So
on the inflation front, we haven't really seen it, at least to the extent that some pessimists out there thought we'd see tariff-induced inflation. We haven't seen that per se. Is it just a question of timing, or in fact, has corporate America kind of ingested all that into their margins?
I would say, Paul, it's all the above. We know that a lot of the companies were eating it until the uncertainty cleared up. So there's been some creeping into the numbers. If you look at the year-to-date, the 3 biggest, I believe, gainers in sort of goods prices are autos, apparel, and alcohol. So these are 3 big things that we import a lot of, and are, in a sense, are all quite necessities.
Yep. So given that backdrop here, is it I guess the Fed? And you look at the work function. The market has only put about a 45% probability that they cut rates here in December, and that's down from nearly 100%. Several weeks ago. How do you think that the Fed will go?
Paul, I think that's in reaction to we had a slew of hawkish Fed comments out in the last week and a half. I think we get 1 or 2. I'd say we get 1 bad jobs number. Those odds go right back to 100%. Despite all the talk of the hawks, I think that the focus is really on the jobs, on the labor market, not the inflation.
Win Thin with us, Chief Economist at Bank of Nassau. We say good morning to all of you across the nation. The way you listen to us as you awake, thank you for your commitment in the early mornings. On YouTube, subscribe. to Bloomberg podcast. I got 8 ways to go here. But, I'm going to...
Bring it on, Tom.
No, I got there's like with you, Dr. Thin, there's like always just 8 ways to go. Deval Joshi over at Bank Credit Analyst has an absolute brilliant note out this morning. And he basically says what you just said. We're going to get some economic data. We're going to see a pivot on the December call. What will the markets do if we see that? He's looking at the short-term real interest rate. And he says we're ready for a huge pop in the markets if we get the confidence of a December rate cut. Do you buy that?
Yeah, I do think the market is just salivating for some further signs of easing. Again, some hawkish comments, all of a sudden the market's kind of, up in arms. But, it's like good news, bad news. Yes, we're getting some bad news on the economic front. I don't look for a recession. I think we're just getting some cracks that are growing. Nothing that some Fed easing can't fix. So to me, a Fed easing would be a win-win for the equity markets. This correction we're seeing now is, I think, healthy. It's been, obviously on a tear. This healthy skepticism is, I think, good for the markets. But the fundamental U.S. story remains solid. I do think the Fed will cut more than the market expecting.
Okay.
But it's all going to depend on the data, and we've been flying blind for the last 5-6 weeks.
This is too much, Paul.
I know.
I mean, to have Win Thin and Mandeep Singh in the same studios.
Back, belly to belly.
Academics here. Have you ever met?
No, I haven't.
Oh my God,
it's
wonderful to have Mandeep Singh of Bloomberg Intelligence and Win
I hear
Thin
you all
with
the
us.
time. I've never met you. Yeah.
Let's do flip on this. How do you digest Mandeep Singh's world of AI, Dr. Thin?
I will say this just from a top-down macro standpoint. I think the investment in AI is certainly I think papering over sort of the what I think are cracks in the consumer, the labor market. So we're getting a very unbalanced.
Yeah.
If you look at the headline, we're growing somewhere 2.5-3% in GDP, but it's a very unbalanced, I think, mix. I'd like to see the consumer feeling a little bit better. We've seen all the consumer sentiment numbers and all that, but I think a $1 million question I think you always get asked is, well, where's AI really? Well, how do you monetize it? Is all this investment going to pay off? That's my biggest question.
We're doing the interview, not you. Mandy, help us out here with the economics. Atlanta Fed GDP now is 4%. There's no one listening or watching this program who thinks it's a 4% economy. Is your world screwing up our data where we have a boom American economy, but it's a fiction?
Well, all this capex is adding to the GDP. I mean, when you think about what the hyperscalers are doing in terms of putting their free cash flow in the form of capex investments.
Can you get closer to the mic? Is this your first time in radio?
I mean, look.
Come on, Mandy, get with it.
So I don't think, there is a reason to question the GDP number because it's driven by capex, simply because everyone sees the potential when it comes to these AI investments they are making, and the use cases are showing up. So to my mind, yes, there's a big upfront investment, but actually that's helping the GDP print as well, to your point.
Look at this, Paul. You got to get us back on the rails, Paul. Help us out here. Retail sales, September, November 25.
Oh, good.
2 days before Thanksgiving.
That's just announced. Okay.
Yeah, just announced. Retail sales will come out September. They'll come out November 25th. So, Win, one of the things about AI that's just starting to creep into the discussion is, particularly as we see some layoffs, is will AI be a net negative for employment? I'm of the opinion, totally uneducated opinion, that yes, it will. That AI will either take jobs or reduce job growth. How do you?
Yeah, I know. I'm with you, Paul. It'll certainly make people more productive, but I can't see how you just see all these stories about recent college graduates from top-notch schools unable to find jobs. It's hard for me to believe that AI will be a net job creator.
Right.
I'm with you, and I'm usually not very pessimistic, but I just look around and just see the stories in the Times about the tech majors who can't find a job. I mean, it's all the entry-level jobs are being taken by AI, I believe. That's the story anyway.
I got ducky bumps. This is great. Ladies and gentlemen, worldwide and across America, Mandeep Singh and Win Thin with us here before this Nvidia report today. Mandeep, it's just so important. The theme that Paul and I have is like clothing in the Carolinas a generation ago. We didn't do the bargain of retraining people. If we have a Mandeep Singh AI world, Nvidia, do we have to retrain people? We broke that bargain 40 years ago. Are we going to break that bargain in your technology again?
I mean, in the world of tech, I would argue, we have been constantly retraining people. If you think of a knowledge worker, using software, whether it's Excel or any other type of productivity software, the number of features that keep coming, which you have to train yourself on to be more productive, that's been the constant theme over the last 30, 40 years. What's changed now is some of this productivity software is going to change, and the tools are going to change in a profound way in terms of AI agents or some of the things that get thrown around. But essentially, it's aimed at using more data. That's what the tools do. And, doing probably deeper work in terms of if there is a pattern in terms of how the work can be done, then AI can probably do it more efficiently. So it's more creative work, more, use of tools. But and I think moving up the curve in terms of a knowledge worker, that's the kind of the new norm.
I just think of the first couple of years of my investment banking career can entirely be done by AI, doing spreadsheets, pitch books, editing.
Is that a true statement? Young IB types, they're like outmoded right now?
I would echo that sentiment as well. You don't need as many people in terms of creating a pitch book or, an IPO document and how you are capturing the data. That's where, you can do things a lot more efficiently.
But you go across every industry, though. Accounting, coding, all that. It's across. That's why it's so... I think the old timers it's so disconcerting.
You're an
to
old
feel
timer?
that. Oh, many years ago I became an old timer. Sorry.
How about on the other side of that coin? Do you think over the longer term, AI can make this economy more productive?
Well, that's the carrot that's dangling out there.
Yeah.
But we got a bunch of sticks to deal with first.
Right.
Okay. John from Singapore calls in and says, talk to Mandeep about Nvidia. Dr. Thin, sit on your hands for a moment. We got to get some business
Absolutely.
done here.
You got to go where the demand is.
Out on LinkedIn, James Banyika, ex-McKinsey, now over at Google, launches Gemini 3.
Yeah.
What does Gemini 3 mean to Nvidia? What does Gemini 3 mean in your world?
Actually, Gemini 3 is quite negative for NVIDIA in the sense that the model was entirely trained on Google's own chips. So far, NVIDIA has had a virtual monopoly for training these large language models, whether it's OpenAI, Anthropic, Meta, any of the frontier LLMs. Now Google has shown they did not have to use any NVIDIA chips for the latest version of their Gemini. So from that perspective, I do think it's a negative, but we're still in that supply-demand mismatch when it comes to these accelerator chips that NVIDIA still has a lot of customers that it can sell to.
Is there an income statement line item or a ratio at 4:30 this afternoon, whatever, that you're focused on?
Oh, absolutely. The guidance for next quarter, we know China has been a factor in terms of the incremental revenue and, the fact that they haven't been able to sell in that market. So what are they going to guide to, assuming no China revenue and just the gigawatt data center build out? That's the big metric that everyone is focused on. How many gigawatt data centers? How many can we build next year through 2030?
Right.
That's
Really
the key
good.
metric.
John wants one more question on NVIDIA. He's on a phone from Singapore.
So talk to us about just, this is going to be a clean quarter vis-a-vis China guidance, right?
Yeah.
So this number, they really do have to beat and raise, don't they?
And which they probably will. The key metric for me is gross margins, because NVIDIA's gross margins actually went down over the past 2 quarters, and they guided to gross margins going back up to mid 70%. That is predicated on their newest architecture, Blackwell, and then going forward, Rubin. So what they're saying is they will command a premium pricing for the latest architecture, which will drive up the gross margins. So to me, if they're able to keep that guide, I think that would be positive for this.
The former vice chairman of the Fed, thank you, Richard Clarida, for listening this morning. He says, get back to Columbia economics. That's what we're going to do right now. Dr. Thin, I look at this, and folks, I can't say this enough. After the prime minister of Singapore, all the internet, Jeff Yu today, out of LSE and all. The question I'm going to ask is so critically important. This goes back to Mundell. Ken Rogoff would say, this goes back to Mundell. Jacob Frenkel would say, this goes back to Mundell. How do you use currency now to judge this modern system and including Mandeep's system? How do you use foreign exchange that you learned at Columbia?
Sure. Well, first of all, Dr. Claret is very, very well respected. We sort of just overlapped. Never took a class with him, but he's very well respected, and nice to know that nice to hear that he listens to the show. That's a good audience to have. Currencies to me act as, is really sort of the arbiter of what's good and bad. It's sort of the shock absorber. It's the asset class that really, I think, speaks to whether the country is doing right or doing wrong. We've moved away from a system of fixed exchange rates, under which Dr. Mandel lived, to a freely floating one. I'm not a fan of pegs. I think we are in this obviously growing period of growing capital flows, and where exchange rates really become the most important asset class in my mind.
Bow on it, because we got to go here. Mandeep Singh's world of American exceptionalism and technology. Do you bring that right over to a resilient U.S. dollar? Sure,
that's part of it. For a while it was the Buy America, right? It was, and that's back at the beginning of this year. The problem that we ran into is that we have an administration that has explicitly wants a weaker dollar, and we've talked about this. The weaker dollar is part of this whole scheme to onshore manufacturing, make manufacturing exports more competitive. But it's a game changer. We haven't seen this we haven't seen a call for a weaker currency since Lloyd Bentsen was Treasury Secretary. So we're going back decades. So it's definitely a clash of problems. Yes, and the markets. To me, the market's always right. The market will decide who's right on this. I think the dollar's probably going to weaken.
10 seconds. Mandeep Singh, Nvidia today. Thumb up, thumb down. What do you think?
Oh, it has to be thumb up because the CapEx numbers have gone up for next year. And every hyperscaler is guiding to more investments for 2026. So a lot of that will trickle down to Nvidia.
When we invented this show, Paul, this is what it's about.
Sure.
Out of the blue, Mandeep Singh and Win Thing together. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
He's out of the University of John Bon Jovi with Parchment from Rutgers and Seton Hall University. Scott Diamond is a grizzled pro at Goldman Sachs Asset Management. It's a muni bond fixed income team. And what I love, Scott, about what you do is you've got trader experience. It's not some 60,000 foot, LaGuardia has these cash flows. Forget about it. It's about not losing money on the trading desk. What's the number one mistake individuals make in buying and selling munis?
They tend to sell at the wrong time, don't they? But that's okay. As a portfolio manager, as a trader, keep those roles combined. It allows you to stay in touch with the market. It's an over-the-phone market. It's an over-the-Bloomberg chat market. A lot of things going on. And I think the way you framed it is right, Tom. I can't be sitting in an office and afraid I'm missing some of that back and forth flow.
You got to be in the trenches.
Sit on the trading desk, in the trenches, combine the portfolio manager with the trader role, and that allows you to respond as the market changes.
What is the most efficient package, given total return, to acquire municipal bonds? Don't tell me it's individual paper. There's got to be a more efficient way to do this.
Well, for a lot of our clients, they like the individual bonds. That's fine. It works for them. But historically, you've had mutual funds. More recently, I just heard the prior segment, ETFs. Who would have thought ETFs come to the municipal bond market, right? I feel like this is Fred Flintstone meeting the Jetsons. We have a market that has tens of thousands of issuers. It's difficult to think of that in an active exchange-traded fund, but we're there. If you look at the flows into the industry so far year to date, plenty of demand. A lot of it's going to ETFs, and importantly, a lot of it's going to active ETFs. And I think that's a reflection of just how fragmented our market is and where the opportunities lie.
I'm just looking at the IN Go function on the Bloomberg terminal. Across the board, municipal bonds have done putting in some solid returns so far for investors. Talk about how the market's performed this year.
It's had a lot to deal with. As you all know, markets have had a lot to deal with. I don't know how many times I've heard the phrase, it's been a long year last month.
Yep.
We have a new administration. We have tariffs. We have one big, beautiful bill to lead up to, and now a shutdown. And the municipal bond market has had to deal with all of that. But I think the story we're going to talk most about for munis in 2025 has been supply. Supply is, for lack of a better phrase, raining down on the market. Our market is used to something in the context of a 400 billion new issue calendar on any given year. Last year we hit 500. This year we're going to come in somewhere around 550 to 560 billion. Wow. Heavy supply. The results, let's see, we've got a yield curve that is much steeper than the US Treasury curve. If the 2s to 30s in Treasuries is around 110, 120 basis points, the 2 to 30-year spread in munis is about 160, 170 basis points. So we've absorbed a lot of that supply, but not without some implications. We've seen credit spreads widen as a lot of that paper comes down. So I think that's probably going to be the real story, and believe it or not, it's probably going to roll into 2026.
I guess what I learned about new issuance in the municipal bond market, they don't issue when they can, i.e. when rates are low. Municipalities issue when they need the money to build the bridge or the road or something like that. So they're not as interest rate sensitive as, say, a corporate borrower would be. So and all I hear about is infrastructure here, infrastructure there. My gateway project is cruising along outside the other side of the river. So should we not expect more issuance even next year?
Absolutely expect heavy issuance for next year. You are spot on in that once a government gets through all of the voter approvals, the engineering work, they're going to come to market and push this project forward. They'll set that structure so that hopefully they can refinance should rates go lower, but odds are that's going to happen. So your question's a good one, and that what's going to happen for 2026, when we sort of scan the street, what is the street looking for? They're looking for us to do exactly this again. 520 to even 620 billion in new issuance is the range. It makes sense.
Right.
We had a lot of issuers rush to the market ahead of the one big beautiful bill, just for concerns there might be some change to tax exemption. There wasn't. A lot of projects that were past due, and now we know with inflation those projects cost a lot more. So expect a replay of this next year.
Give us a snapshot on what you do. Scott Diamond with his folks, Goldman Sachs, with all of their different investments in municipal bonds. So I've got the Massachusetts State Development, Beth Israel Lahey Health issue. It's in one of your portfolios. It's out, I think, 15 years, if my math is right. It's a 5% coupon. Can the little guy get access to that piece? I mean, that world, is that only an institutional world?
Well, yes, an individual could, but I think where the individual is not going to be able to stay on top of that is, are they going to check the quarterlies that Lahey needs to come out with every quarter? How are they doing? One big beautiful bill has a lot of things in it, right? There's going to be some changes to Medicaid. There's going to be fewer reimbursements, phased in, thankfully, over time. But that's going to be a trend that if you own that bond, you want to watch and see how that impacts the financials of that institution. So do you, as an individual, have that capability, or perhaps more importantly, the desire to stay on top of your individual municipal bonds? If you go into a commingled vehicle, you're essentially hiring us and our impressive 10-person research team to stay on top of that, spot if there's an issue coming up, and maybe we exit that and get into something else.
Paul, you should see their Knicks tickets.
Oh, I know.
All 10 of them go at once to see the Knicks play.
Tom, I've got the laddered muni of New Jersey municipal bonds. It's a ladder.
You're very laddered.
I'm laddered. Yeah, so I'm like the largest creditor to the state of New Jersey.
Is that a gimmick or is that for real? Like everybody should ladder, or the phrases that retail uses, barbell your munis, or that. Is there a validity to a laddered approach?
I think so, Tom. Again, it's going to come down to you as an investor. What are you trying to achieve? And a lot of our clients like that consistency of a laddered portfolio. I know that I can expect a certain amount maturing each year for the next handful of years. If a bond comes to you at maturity, just redeploy it at the top of the ladder. There's a simplicity to it. I've done munis for a long time. I love this market. Infrastructure, the whole concept, you're building something. I love that we have 50 states, we have U.S. territories, we have short bonds, long bonds. I think of this market as just ripe for opportunity. right? You have passive options. You could do a ladder. You could do a passive ETF. But if I've got tens of thousands of issuers, bonds across the go ahead.
I got to get this in. I got 40 seconds left. Are you guys in the AI space? Like all the energy needs and funding, is that going to be a muni bond opportunity?
I think it's got the potential to increase some supply, right? A lot of that has to get built. So we're going to need new generation.
Exactly.
We're going to need new transmission. And some of that could come, I think some of it will go private, but some of that's going to land on the public.
I can see you, Paul, a muni bond in New Jersey.
Sure.
With an, AI.
I call up the governor, picks up the first ring.
Do you?
Yep.
Governor Christie?
Yeah, exactly.
Thank you, Scott. It's brilliant. Don't be a stranger. Scott Diamond with Goldman Sachs here on the efficacy of taking advantage of tax-free bond. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Lisa Mateo with the newspapers.
All right, you mentioned Paramount Plus. That's the Paramount Plus. Let's start with Paramount. Okay, we know they had a number of efforts, right, to try and buy Warner Brothers Discovery. Hasn't worked out yet. But sources are telling the Financial Times that David Ellison actually met with Saudi Arabia's Public Investment Fund, other officials from the region, because they expressed interest in taking part of that bid. So no agreement has been reached. Conversations are, quote, active, but it just shows the scale of financing that he needs.
So it's like in the Lincoln bedroom or the green room at the White House for the, MBS is here. We're like, so let's have a meeting here,
Well, the problem is, or the math is very simple. Paramount's got an enterprise value of about $30 billion. Warner Brothers Discovery, who they want to buy, has an enterprise value of about $90 billion.
How do you do that?
You bring in external equity. So you get that from Mr. Ellison himself. You get that from private equity. You get that from sovereign wealth funds. Anybody who has can write a big check. Come on in, we'll take your equity.
And Charlie Gasparino over at the New York Post is talking to Mr. Roberts and Comcast.
Yep.
I don't know the details, but this is active.
Yeah.
What's your thought? How does this end up?
Well, I think if I'm Warner Brothers Discovery, I want to sell to Paramount because they want to buy the whole thing. And that would be the easiest, smoothest, cleanest. But they're prepared to go the other way, too, which is I'll sell you my studio and my HBO, and I'll just spin out the rest.
Fish is up 24. Next.
Oh, and then Saudi Arabia actually wants to get more into this.
Exactly.
They're expanding into this entertainment space. Okay, so let's go back. You remember the auction house that sold that more than $12 million gold toilet? Okay, of course. There's a new it's a story that keeps giving, guys. I'm telling you, it holds a new record. Okay, so this is a Gustav Klimt painting. It sold for hang tight, $236.4 million last night at Sotheby's. It was actually the first auction in that new home. They have New York's Breuer building, so it was the first auction there. But it makes it the world's most expensive modern artwork at auction, the second priciest work of art auctioned overall. So the piece is called Portrait of Elizabeth Lederer, okay? It has, the picture of a woman standing in a white gown against this backdrop. It got like 6 people bidding for it. But it's just a good sign because it shows that the art market, which is really kind of sluggish lately, it's been turning around, and you're seeing this turnaround in the art market.
And it's part of the New York City fabric. This is Mr. Lauder, who was of his estate, and it's a huge number, but it goes to the commitment we've seen from the Jewish Museum in New York City to Gustav Klimt. And there's a whole series of paintings he's done. This one is spectacular. My amateur take is it's just a whole league above of a lot of the others. Like, the number seems, is it $250 billion?
Yeah.
$1 billion?
I wonder who bought it. Anyway,
we don't know.
We don't know who bought it.
We don't know who bought it.
It's not Mets owner who bought the dog.
Yeah, I was going to say.
No, it's not.
That was the first name that came to my mind.
Juan Soto. See ya. Next.
Okay. We've heard a lot of stories about a lot of people going California sober. Okay, this is when they use marijuana and other drugs, but not alcohol, because they say it's healthier. It's become this trendy thing. So there's a new study that suggests people drink considerably less after they smoke cannabis. So it kind of linked it. It's a new published study. So they took about 150 people who regularly use marijuana and alcohol. They put them into this makeshift bar on campus at Brown University, and they tested because they want to know how much people drink after they smoke cannabis. And it turns out they did drink less after they smoked cannabis. I don't know what kind of connection. The gummies, the edible, but they were strictly smoking cannabis. This was strictly smoking. Like they had to inhale at the same time. Like it was this whole procedure behind it.
Controlled test.
But that's what exactly did it show, that were less likely to drink after doing that.
That's what I hear from folks that are in the gummy space. All right.
Okay.
Good stuff there.
Thank you, Lisa. Thank you so much. It is the newspapers with Lisa. Mateo.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.